Welcome to the Daily Globe. Please subscribe and hit the bell icon for more breaking updates. In today's interconnected world, the movement of capital across borders often reveals not just economic trends, but also shifting power dynamics and the emergence of unexpected partnerships. The global financial landscape is constantly evolving, with new players stepping onto the stage and traditional roles being challenged in surprising ways. So, why would a developing nation like the Philippines consider loaning $250 million to the European Union, a major economic powerhouse known for its wealth and influence? At first glance, this scenario seems almost unthinkable, flipping our expectations about who lends and who borrows in the world of international finance. The question challenges the usual script of global finance, where developed countries are typically the lenders and developing nations the recipients. It invites us to reconsider the established narrative and look for deeper meaning behind the headlines. If such a scenario were true, it would upend long-held assumptions about who holds financial leverage and who is in need of support. It would force us to rethink the balance of power and the nature of economic relationships between nations. The implications would be profound, marking a potential new era in development economics and international relations. It could signal a shift in how countries collaborate, invest, and support each other on the world stage. But before we accept this narrative, we need to ask, is this really the case? To get to the truth, we must dig deeper, beyond the attention-grabbing headlines and into the actual data and facts that shape these financial relationships. This story isn't just about money changing hands, it's about evolving partnerships, shifting priorities, and the complex ties that bind Southeast Asia and Europe together in today's globalized economy. Let's take a closer look at the evidence, challenge the myths, and uncover the true nature of the financial relationship between the Philippines and the European Union. Only by examining the facts can we understand what's really at stake. Is this a story of newfound strength and changing fortunes, or is the reality far more nuanced and complex than it first appears? Let's address the central question that's been circulating online and in conversations for some time now. Did the Philippines really loan $250 million to the European Union? It's a claim that sparked curiosity, confusion, and even heated debates on social media and in the news. The answer is clear: no such loan has ever occurred. Despite the rumors, there is absolutely no record of this transaction ever taking place. There's no evidence in official records, government statements, or financial institutions to support this claim. If such a significant loan had happened, it would be documented in public records and widely reported by credible news outlets. The idea likely stems from misinformation or confusion about how international finance works. In today's digital age, rumors can spread quickly, especially when they sound sensational or surprising. Sometimes contributions to global institutions like the International Monetary Fund are mistaken for direct loans between countries. But these contributions are pooled resources, not bilateral loans, and they serve a completely different purpose. The EU, with its vast financial resources and robust economic systems, raises capital through its own mechanisms, such as issuing bonds and collecting contributions from its member states. It has no need to borrow from developing nations like the Philippines. In reality, the financial flow has always been the opposite. Funds and support typically move from the EU to the Philippines. This comes in the form of development aid, grants, and technical assistance, all aimed at supporting growth and cooperation. Recognizing this helps us move past the myth and focus on the real partnership that exists between the EU and the Philippines, a relationship built on mutual respect, shared goals, and documented agreements. The true story is about documented support, not imagined debt. These agreements are transparent, verifiable, and benefit both parties in tangible ways. Let's explore what this partnership actually looks like and how it continues to shape opportunities and progress for the Philippines. The EU-Philippines financial relationship is defined by the EU's role as a major donor. For decades, the EU has provided consistent humanitarian and development aid to the Philippines, especially in response to natural disasters. Since 1996, the EU has given over €170 million in humanitarian funding, supporting recovery after typhoons, floods, and earthquakes. Aid also targets long-term challenges, like the conflict in Mindanao, helping displaced and vulnerable communities. This support is ongoing, not a one-time payment, and addresses both immediate crises and deeper social issues. The EU's commitment contradicts the idea of the Philippines as a lender. The real story is one of sustained support and partnership. EU aid to the Philippines is delivered through trusted partners, UN agencies, the Red Cross, and NGOs, ensuring effective, targeted relief. When disasters strike, the EU's emergency response is swift. Shelter, clean water, food, and medical aid reach those in need. Beyond emergencies, the EU invests in disaster preparedness, training local teams, improving early warning systems, and promoting resilient construction. In conflict zones like Mindanao, aid includes legal support, protection for vulnerable groups, and safe spaces for women and children. This comprehensive approach addresses both immediate needs and long-term resilience. EU funding adapts to the specific challenges of each region. The focus is on empowering communities, not just providing relief. This is humanitarian aid in action, responsive, strategic, and deeply rooted in partnership. In 2025, the EU has allocated €6 million for humanitarian aid and disaster preparedness in the Philippines. This funding is part of a broader strategy to enhance resilience and reduce the impact of natural disasters in the region. The EU's commitment is not just about the money, it's about building a sustainable future for vulnerable communities. While this may seem modest compared to the mythical $250 million loan, its impact is significant and targeted. The €6 million is carefully allocated to ensure maximum benefit, focusing on areas that need it the most. This approach ensures that every euro spent has a direct and meaningful impact on the ground. The funding supports projects that benefit vulnerable communities before disasters even strike. This proactive approach includes training, supplies, and infrastructure improvements that can save lives and reduce damage when natural disasters occur. This approach combines steady annual support with the flexibility to respond to emergencies, as seen in previous years. The EU's ongoing presence in the Philippines has built a foundation of trust and cooperation, enabling swift and effective responses when disasters strike. Aid is directed to high-risk areas and conflict-affected regions like Mindanao, reflecting a nuanced understanding of the country's needs. By focusing on these areas, the EU helps to stabilize communities and promote peace and development. The EU's support is consistent, principled, and based solely on humanitarian need. This ensures that aid reaches those who need it most, without any political or military interference. It stands out for its reliability and focus on neutrality and independence. The EU's aid efforts are recognized for their transparency and commitment to humanitarian principles. The 2025 commitment reaffirms the EU's role as a steadfast partner. This new agreement symbolizes a continued dedication to supporting the Philippines in times of need. The real financial story is one of partnership and resilience, not debt. Together, the EU and the Philippines are building a future where communities are stronger and more prepared for whatever challenges lie ahead. EU aid has a ripple effect across Philippine society and economy. Cash assistance stabilizes local economies after disasters, keeping businesses afloat and empowering families to prioritize their needs. By working with local NGOs, the EU strengthens civil society and community resilience, fostering ownership and long-term sustainability. Aid projects often include training, disaster risk reduction, and climate adaptation, building capacity for the future. Politically, EU aid is a cornerstone of diplomatic ties, but it can also spark debate, especially around human rights. The EU links aid and trade preferences to human rights standards, sometimes causing friction but also encouraging progress. Ultimately, EU support is about building capacity, not dependency. The goal, a more resilient, self-sufficient Philippines. This is the lasting impact of EU financial support. The EU-Philippines relationship goes beyond aid. It's also about trade, politics, and shared interests. The EU is one of the Philippines' top trading partners, with thousands of products exchanged annually. The GSP Plus scheme allows the Philippines to export over 6,000 products to the EU tariff-free, driving economic growth. This access depends on upholding international standards for human rights and governance, linking trade to domestic policy. Regular political dialogue covers security, climate change, and the rule of law, reflecting a broad, strategic partnership. The EU supports ASEAN's regional framework and a rules-based order, aligning with Philippine interests. Aid and trade together create a partnership where both sides benefit economically, politically, and strategically. The real relationship is one of mutual value, not debt. Experts in economics and international relations quickly dismiss the idea of a Philippine loan to the EU. The EU's economy dwarfs that of the Philippines, and it sources funds from global capital markets, not developing nations. Political analysts see EU aid as a tool for stability and partnership in Southeast Asia. Humanitarian experts praise the EU's reliability and principled approach, especially in crisis response. Trade specialists highlight the GSP Plus scheme as the most valuable financial aspect for the Philippines. The real economic benefit comes from trade, not imagined loans. These expert perspectives reinforce the true direction of financial flows. The narrative should focus on real opportunities and support, not myths. The partnership is about investment in resilience and shared prosperity. The question of a $250 million Philippine loan to the EU is a myth. No such loan exists. The real financial relationship is defined by decades of EU aid, totaling over 170 million euros, and ongoing support for disaster response and development. Trade, through GSP Plus and political dialogue, are equally vital pillars of this partnership. EU aid is an investment in stability and resilience, not a sign of debt or dependency. Understanding the facts allows for honest discussion about maximizing trade, improving aid, and navigating political challenges. The EU and the Philippines are partners, not debtor and creditor. Let's focus on the real opportunities and challenges that define this evolving relationship. By staying informed, we can help shape a more secure and prosperous future for both sides.